Investors and media friends, good afternoon. Thank you for participating in the 2025 over investor conference. I'm Jenny Wang, the CFO of KGI Financial. And here we will talk about the financial overviews of the holding company and the subsidiaries, and also the 2024 EV of KGIL. The senior management, including KGI Life, KGI Bank, KGI Securities, and CIB Capital Vehicle, and the actuary manager at KGIL. And after the presentation, we will have a Q&A session, and we'll promote you to raise questions through WebEx. And first of all, I will talk about the overview. We go to pages of the offering. KGI Financial's net income in the first quarter is 8.7 billion, a 6% growth year-on-year. And KGIL by KGI BO the growth, KGI Securities and CIB Capital we see some losses. And the total equity on the right, but due to the equity volatility on the total equity likely dropped to 209 billion. This page has the subsidiaries. And as for KGI Life, Q1 profit grew 20% compared with the last year. In the first quarter, the policy sales momentum was strong, and FYP's growth more than 70%. In April, we also see the momentum sustain. Since KGIL adopted the new mechanism of the foreign exchange reserve in the first quarter, even in April, the hedging cost is relatively stable. However, in May, due to the sharp increase appreciate and unstable we see the challenge to KGI Life. As for KGI Bank, the Q1 net income grew 14% year-on-year. In loan and wealth management, we see double-digit growth, especially the fee income in wealth management. There's more than 30% year-on-year. And in April and May, for KGIB, the wealth management performance and the program team in returns of corporate customers, due to the uncertainty of capital and the capital who serve the corporate customers as they turn to conservative in the short term. However, we also see the demand of fund allocation as happening for the customer, although satisfy the needs of the customers. And on the next stage, the KGI Securities. In the first quarter, net income decreased 36% year-on-year. Development investment come in the same period last year was relatively high, and this year the market is more volatile, so it was impacted. However, in wealth management, in terms of the scale and revenue, the both double-digit growth. For CIB Capital, was reported a net loss in Q1 due to the volatility in the market. However, CIB still raised more than 1 billion funds. And Q1 we also raised new funds, and the target that's 8 billion. For the next page, the capital adequacy ratio of the subsidiaries are all adequate. And you are more excited about KGI Life in May. Due to the effects on market volatility, KGI Life RBC for network balance of both higher than the regulatory requirements. Like a brief introduction, next I'll hand over to Andy Just, our investment investor in investment management.
First KPI like, please go to slide 16. You can see premium income. Q1 FYP grew by 74% year-on-year, with growth momentum coming from single pay and ILP. This is mainly because KGI Life fully understands the demand of different customer group and provides a complete product line offering more options for policyholder fund allocation. For mid to long term, our product strategy still focuses on product with high CSM and BMV. If we look at FYP product mix, all products saw growth year on year, and this is in line with our product strategy. Next slide. Frequency BMV. Because of the changes in product mix, BMV remains the same. And because part of the BMV in Q1 last year came from deferred booking of health insurance, so it was a relatively high base. If we exclude the impact, the contribution in Q1 would be better. BMV margin, due to product mix changes, now it stands at 27.3%. For investment spread, COL is 3.1 and investment return 3.8, maintaining a positive spread. Page 18, investment portfolio remains prudent in Q1 compared to the end of last year, mainly due to the adjustment in domestic stock and increase in foreign deposits. In response to market fluctuation, our overall strategy still focuses on risk management and stability. Next slide. Investment performance, pre-hedging recurring yield, 3.6%, up 15 bits year on year. This is also due to FX because USD was stronger in Q1 this year than that of the last. And for hedging cost, this is the figure in Q1 under the new FX reserve system. It includes hedging point cost and the provision of FX reserve. The hedging cost in Q1 is 1.27%. And our hedging structure by the end of March, our reserve balance is 39 billion. Now, let's move on to the EBP assumptions. On page 20, economic assumptions. There are two main factors for the changes in NTD policy. First, because Fed might cut rates and the narrowing of Taiwan and US spread will reduce hedging cost. And then for the long term, because of aligning with IFRS 17, this will reduce foreign investment and further reduce currency mismatch. And for USD policies, there are no significant changes. Next slide. Yield assumption. This is for your reference. In 2024, the overall equivalent yield is 4.24%, the same as last year. And for NTD policies, the figure is 3.92, and for USD policy, it's 4.92. Page 22 are year-on-year comparison. First, adjusted net worth increased by 36.6%. This is reflecting the increase of net income and asset valuation. The overall EV increased 11% year on year. And for changes, it will be explained in the following pages. Next, adjusted net worth from the shareholders' equity due to the increase of FX reserve reaching 30 billion. The adjusted net worth reached 231.5 billion. Page 24, value of in-force. The two bigger changes. First, change of investment yield assumption. This reflects the impact of investment yield shift. Second, change of other assumptions. It reflects large amount of policy surrender last year and also the one-time release of reserve to the adjusted net worth due to the application of the new FX reserve system. Page 35, VNB, the two figure changes. First, outflows led to an increase of 2.1 billion, and because of market demand for single pay policies, changes in product mix led to a decrease of 1.2, but overall it still increased annually. Next, sensitivity analysis. It is presented here for your reference. Next, KGI Bank.
Please look at page 29. The incoming first column is 1.17 billion, 11% growth year-on-year. It is mainly driven by the long business bond and increasing fees. The overall net income, net interest income by 24%, with wealth management fee growing by 37%. The left side, you can see the deposit loss spread in the first quarter were 1.95 and 1.31%, but actually slightly dropped year-on-year. And mainly due to the asset growth strategies, we see strong growth in loans, and especially in the larger corporation and mortgage help, compressing the spread in the income. On the right side, the asset quality remains stable. At the end of last year, the black hole of consumer loan, that was the years, the overdue loan ratio and Fed Funds coverage ratio are in central debt risk level. The overdue loan ratio in Q1 0.19%. It was with the single case net NPL ratio of the 0.41%. In the next stages, along the other trend. In the total loans to individual and corporate loans, when CD will show double-digit growth. On the right side, the total deposit grew by 14%, and then due to the growth in FTD deposit. Next is KGI Securities. Please look at page 7. Good. On the upward left, as we mentioned in the first quarter, due to volatile market and the transaction volume was low, and the net income decreased year-on-year, including around fees of brokerage and investment costs. Meanwhile, the KGI diverted its trend which involved larger business than the forex only. The short-term market demand is what is a bilateral energy product strategy. The AUM of wealth management grew by 1% year-on-year. On the left-hand side, the revenue goes up by 6%. And that's it. On the upper left, this is the overseas contribution. Benefiting from the significant increase in costs as daily volume Q1 and growing business rapidly. The Q1 overseas profit grew about 10% and contributed 18.5% post-tax net profit of the securities. In terms of profitability, Q1 net profit was 1.8 billion, that is similar to industry average, and also we take the monthly efficiency. Next is KGI size. Please refer to page 37. As of the end of first quarter, KGI size public fund AUM is at 316.2 billion, ranking 7th in the industry. Next page, a more detailed breakdown in the ETF AUM in Q1. KGI size recorded a 7.34% growth, which is surpassing the industry average growth of 2.07%. And the number of beneficiaries also is approaching 300,000, and our target is to reach 400,000 by 2025. KGI plans to launch Taiwan's first equity fund balanced multi-asset ETF at the end of July, and this is also to meet the market's need. And this will be a 70-30 equity to fund asset allocation, allowing investors to long-term growth. And last but not least, the CDI on page 42. Q1, we have a new asset management business established, and 3 existing businesses continue to raise funds. The total AUM is at 59.5 billion. Although the fundraising increased by 1 billion in Q1, but the overall asset management scale appear to be stable compared to the end of last year due to investment recovery change and changes in position valuations. And Q1 principal investments grew 2%, as this is due to the new investment program and changes in decision valuations. And on the performance, the asset management income is 180 million, representing a 33% increase, and this shows our fundraising resulting as markets since 2020. Overall stability of ROI is superior to the MSCI World Index. This reflects CDIB's strategic focus on pursuing stable investment return. And for private credit, the business scale continued to expand. It also consistently contributes stable interest income and fee income to CDIB. And just above are the business performance of our subsidiaries. Now we're entering our Q&A section. We'll first invite the corporate investor to raise question. Remember to click on the raise your hands button for you raise your question, and also mute yourself if you cannot speak. First is Jamie from JP Morgan, please. When my questions first record the bank, the main quarter-on-quarter, it seems there to be a decrease. So what is the driver for your growth? And in the following quarters, what would be your expectation for NIM? Is it going to be stable despite that Fed might lower the rates? And question for life, if we look at the hedging mix, your position is actually quite high. So what is your April and May strategy in terms of the adjustment hedge? If there wasn't any, what is your FX reserve now? Do you still have any open position in your FX reserve? If you still have balance and then this is running out, what will be your corresponding measure to address that? And also, you are going to launch the participating policies in the near round. So, what impact would it bring to the interest-sensitive products? And how would this participating policy contribute to your PSM and ICS if you compare them with interest-sensitive products? And 2 more questions on EV. We talked about the EV equivalent investment returns year-on-year is flat. Your figure in 2023 was 4.24, and what will be the likely expectation in 2024? And can you also provide a figure for us? As if I did not get it wrong, in page 24, your assumptions on actuarial changes. You said there was the impact for the new FX mechanism. Does it mean that you are moving to the new FX system and then there will be a decrease on the original position? So can you share with us what is the exact change on your actuarial changes and how it impacts your FX reserve? Okay, we'll invite CFO from PGIB to answer such related to me. Hi, Jamie. The first question is about the NIM of KGI. Yes, our full year NIM is 1.3%, and in Q1 this year is about the same. And for next three quarters or even the whole year, we would like to maintain at the current level or improve the thing. And the main driver for me on Q1 is the cost of capital, as we launching the 1KGI strategy and the possibility of lower interest rate by its Fed will believe the cost of the fund will have a drive for NIM. Say last year's, we saw the loan growth. In the next quarters, we will hope to adjust the constitution of loan and adjust the loan mix and try to improve the spread and also make the use of funds more efficiently. So under the two strategies, overall, we expect the spreads and need to maintain at the same level as that was last year's or even slightly improve it.
I'm from KGI Life. Regarding hedging strategy, indeed, our hedging ratio is low because NTD was stable. However, now it has fluctuated a lot. Recently, we have increased our hedging ratio to from around 55 to 60%. Our strategy moving forward, we know that NDF is very expensive now. So considering the trend, we will use traditional hedging together with the proxy hedge. This will be the tools that we use for hedging. Regarding the EV assumption, last year the equivalent rate was 4.24. After 1 year, it's 4.34, and now it goes back to 4.24%. For VNB equivalent yield, it's around 4.6 to 4.7. And for actuary assumption, 40% of it because of the new FX reserve system, and others are due to other assumptions like lapse rate and also the changes in policy assumed rate. And for CSM and ICS, for participating policies, for interest-sensitive products, under ICS, there is a system that can offset risk. So the impact will be offset accordingly.
Next one, invite Tina from Capital Investing. And I want to follow up on the KGI Life's hedging strategy. Can you provide us with your FX sensitivity analysis? For example, 1% appreciation of NTD, how would it affect your FX reserve? And also, what is for FX reserve balance at the end of April? And what is your assumption of the maximum appreciation amount of NTD to totally offset your FX reserve? And are you going to increase more than reserves? And next questions are about KGI's bank. And you talked about due to the tariff uncertainty, you will have a more conservative loan strategy. That what will be your guidance for your loan growth? Would it still be about 10%? And again, back to life, your unrealized loss appear to be expanding. So what is the mix between your equity and bond? in terms of unrealized losses, and what is your unrealized gain or loss on rates? And
KGI Life, CFO, for the FX reserve sensitivity, our overall exposure if we do calculation for every 0.1% of appreciation, it will affect 1.7 billion. Because for FX, we need to factor the unrealized gain of hedging tools and also proxy hedge. So because of the tools, the actual amount will be less than 1.7 billion. Our initial break even is around 3 billion. Our loss is not $0.1 of NTD and times 1.7 billion. We also need to look at investment gains and our gains in our business. We need to factor in all these to have a more comprehensive understanding. For unrealized loss, there are two parts. Since this year, we have realized some equity gain. So it is affected, and also due to market fluctuation. But now stock has rallied, so the figure has gone down. And for bonds, over 90% are parked in AC, so the impact is not as big.
That's soft. Answer question related to the a little forecasting. Can you pay 30 of a bond point? That is the year-on-year growth. The Q1 this year versus Q1 last year. You can look at the year to month growth. Our last part is about 5%. The corporate and mortgage loan growth above 5%. The loan outlook for this year, we see more uncertainty and the volatility in the market for the events from the corporate. However, in the first quarter, we see a outstanding number. So we expect this year that we can maintain about 10% in this year with that growth. Without a plan to adjust down the number, but I'd like to emphasize our strategy is not only to grow the scale of loan, but to improve the loan spread and the fee income growth. This is the focus of our strategy. Cover that both. If you have questions, please click the raise your hand button. We'll invite CNA's correspondents. Jim, please unmute yourself. Please, the floor is yours. Again, to KGI, your FX reserve balance is 21.2 billion. Is that correct? And in your product mix, comparing to last quarter, in your real estate position, we have seen some losses. And what is the reason? And my second question is to Keisha as the second in the market share in your DCM and ECM. What is the cause, and are there any challenges imposed on you on your primary markets? And also, we learned that there is a fintech circulation circle where you have discussed with the SEF. Are there any progress as of now?
Well, answer regarding KGI Life, our FX reserve is 21.2 billion. That's correct. And for real estate, the figure went down is because in Q1 we did revaluation. Therefore there are some decrease, as you can see here.
From Hinge Securities about the underwriting smart agents that are like thank you for the question. Hinge Securities, like what you know, we maintained number 1, number 2, and this year is only the Q1 ranking. This is maybe due to financial statement submission time back without back behind, but our internal target is to maintain the top ranking, top 1, the top 2. Thank you. For our bracket, CDI being cancelled, the relevant fund was still doing the planning and fundraising detail discussion. If we have further information, we will share it. And next, we'll invite another correspondent, Ms. Shannon. We can hear you, please. I have several questions for KGI Life. The first on your slide 19, the hedging ratio, 42% here. Is it representing the proxy and open, the sum of proxy and open? And here, are you showing the ones that you're using the cover overlay method, that it doesn't affect the eventual number? And if that's the right assumption, so what is the figure for proxy? What is the positive amount for proxy as of March? And second question, the CFO of KGI Life mentioned that if there is a $0.25 dollar decrease, how would it impact your pre-tax income? If we exclude hedging costs, we look at the hedge position and their FX gain or loss, and also look at the FX reserve, as well as the contractual gains or loss. If we use that assumption, if there's a 1% appreciation in NTD, how would it consume your FX balance, reserve balance? And the April, your BIXF, you talk about the changes in your assumption, and there will be a impact of 20 billion coming from the surrender of rates and also your reduction of the skill capping mechanism. So among these two, 20.2 billion, what is the ratio of each?
Regarding page 19, hedging structure, 42% in addition to USD, we also have other currency assets, for example, of Australian dollar. It's not just unhedged USD position and proxy. And for 9% overseas equity, it's our equity product. After the transition, we need to reclassify, we take out overlay. I can put it in OCI or PBL, so that's that part. And at the end of last year and the first quarter, the proxy position, considering the effectiveness at the end of last year and the end of Q1, the position is very small. So the position is not big. Next, regarding the FX fluctuation impact on our gain and loss, it's difficult to give you a specific number because for valuation, it fluctuates a lot. For NDS, it can go up to as high as 40% and as low as 7%. And because we increased our proxy hedge position, and so different currencies fluctuation will have an impact. These two factors are the things that we pay attention daily, and it's very difficult to give you an exact number on how big the impact will be. And page 24, 40.2 billion, 40% of it comes to the new FX reserve system, and the rest comes from surrender.
Thank you to dear investors and friends from media. We are not receiving any new questions, and that marks the end of our Q1 investor call. Thank you for participating.